Hey Money Mavericks, welcome back to Money Made Easy. Today we re-diving deep into a seismic shift in the global financial landscape, a story that's been brewing for years and is now demanding our full attention. We're talking about the end of an era, the potential unraveling of a financial illusion that has shaped the world for decades. For generations, the United States has operated with a seemingly limitless credit card, a privilege that allowed it to spend with an implicit understanding that its debts would always be honored. But that era might be drawing to a close. The recent downgrade of America's sovereign debt rating isn't just a blip on the radar. It's a glaring spotlight illuminating an uncomfortable truth. The time when the US could print money with impunity may be coming to an end. This isn't just a signal. It's a reflection on a changing world order. The idea that American debt was untouchable, the bedrock upon which the entire global financial system rested, is now being questioned. Credit rating agencies, those often mysterious arbiters of sovereign creditworthiness, play a crucial role in this drama. Their judgments can open or slam shut the doors of global markets for entire nations. But in the case of the United States, the impact feels more symbolic, yet profoundly significant. Think about Moody's recent decision. The final piece of the puzzle, after Standard & Poor's downgrade back in 2011 and Fitch's follow-up in 2023, this deserves our attention. It's not just for the final assessment, but for the underlying reasons. It's there in the justification that we find the true diagnosis of America's financial challenges, a stark reminder that the seemingly robust U.S. economic equilibrium still precariously balances on three pillars: the dollar's status as the global reserve currency, the Federal Reserve's independence as the monetary authority, and the constitutional separation of powers. Today, all three are facing unprecedented scrutiny. In this video, I'm going to break down this complex situation in simple terms, and I'm confident you'll grasp the gravity of it once and for all. Please remember that the information provided in this video is for educational and informational purposes only and should not be considered financial advice. Analyzing sovereign debt ratings and global economic trends involves complex factors and uncertainties. Individual financial decisions should always be based on thorough research and consultation with qualified financial professionals. Let's start with the core reasons behind the downgrade, a diagnosis that's becoming a chronic condition: rising debt, out of control, interest payments, and a political inability to change course. The rating agency was blunt. America's fiscal trajectory is compromised. The federal debt approaching $2 trillion annually, roughly 6% of the entire gross domestic product. This is a level not seen even during the worst crises of the 1970s and 1980s. Furthermore, interest expenses have already skyrocketed to nearly $780 billion, second only to Social Security spending. These are staggering figures, even for the world's largest economy, and they are projected to climb. By 2035, interest payments alone could reach $1.8 trillion, a staggering 15% of the entire public expenditure. Let's pause on the deficit for a moment because understanding it is crucial. It's a vital and critical measure of a country's financial health. Moody's forecasts the deficit to rise to 9% of GDP by 2035. And this projection doesn't even factor in potential external shocks like health crises, wars, extreme weather events, or new recessions. Essentially, this is an optimistic scenario that ignores the inherent unpredictability of reality. And even under these rosy assumptions, it's enough to make you uneasy. See, the deficit isn't the total amount of debt. It tells us how much a government spends each year, in excess of what it takes in. If the American GDP, for example, is $1,000 billion, then each year the government is spending $90 billion more than it's collecting. The Congressional Budget Office has gone even further in its projections. If this trajectory continues, they stated, by 2055, American public debt will reach 180% of GDP. That means the national debt would be nearly double what the entire country produces in a year. Meanwhile, in Washington, no one seems willing to alter course significantly. The previous administration aimed to extend tax cuts, further exacerbating the deficit. The only concrete proposals involve reductions in spending for food stamps and Medicaid, which are insufficient to offset the combined effect of tax breaks, demographic aging, and increased spending on Social Security, and the ever-growing interest on the debt. To illustrate the gravity of the situation, The CBO drew a chilling parallel to the mini-budget proposed by Liz Truss in the UK in 2022. Remember that? It was the plan that caused the pound to plummet and government bond yields to spike, ultimately forcing the British Prime Minister to resign in less than 2 months. But there was a key difference. The British deficit at the time was 3.9% of GDP. The American deficit today is almost double that. Yes, the United States has a vast and deep government bond market, very different from the UK's. However, US Treasury yields continue to rise, and as interest rates climb, the cost of refinancing the debt increases. This explains why bond markets are far more jittery than stock markets. The infamous bond vigilantes, those who monitor the market, have already begun to move. And yields have risen sharply, particularly on longer-term maturities. The term premium on treasuries is at historic highs, and the CBO's forecast is clear. By the 2030s, 22% of American tax revenue will be solely dedicated to paying interest. Essentially, 1 out of every 5 taxpayers will be working just to cover past debt. In short, the United States no longer appears as untouchable and immortal as it once did. It too will have to grapple with the same problems that Italy and many European countries have faced for years. First, an increase in interest payments. The more debt you have, the more interest you must pay to those who lend you money: banks, investors, pension funds, and other nations. If interest rates are high, as they are today, these payments become an enormous expense. Second, less money for public services. If a large portion of tax revenue is used to pay interest, fewer resources remain for schools, healthcare, infrastructure, and pensions. Debt eats away at public services. Third, a decline in market confidence. If investors begin to believe that the United States will not be able to control its debt, they will demand higher interest rates to continue lending money. If confidence drops too much, they might even stop lending altogether, or start selling off their holdings of US Treasury bonds. Fourth, the weakening of the dollar's power. The US dollar is not just any currency. It's the world's reserve currency. The currency that governments, central banks, and large financial institutions use to store value, their so-called foreign exchange reserves, and to conduct international trade. Over 60% of global trade is done in dollars. To buy raw materials, oil for example, you buy in dollars. To issue and buy sovereign or corporate bonds, it's as if the dollar is the universal language of global finance. This status confers immense power on the United States, a power no other country in the world possesses. They can print money to finance their debt because the world will buy it. To give you a comparison, if Italy printed too many euros to cover its debt, the spread would explode. The United States does it, the Fed prints dollars. China and other countries buy them, and the system keeps turning until it seizes up. The point is that this trust is not automatic. It's granted, but it can also be withdrawn. As long as debt grows but economic growth holds up, the system works. But if the debt-to-GDP ratio rises too high, the deficit spirals out of control. And American politics shows no willingness to change course with serious spending cuts and new tax revenues. The world might begin to lose confidence in the United States. Investors are already starting to see the dollar as less reliable, as a more inflationary currency, and are seeking alternatives. If the dollar loses its status as the global reserve currency, the following will occur. Demand for US Treasury bonds will fall, interest rates will rise, and debt will become more expensive. The United States will no longer be able to print money with impunity, leading to less fiscal flexibility. The dollar will depreciate, increasing imported inflation. Dollar-denominated financial assets will become less attractive, leading to less foreign investment. It's as if the United States suddenly loses its privilege of having an unlimited credit card without ever having to prove its ability to repay. These concepts I've illustrated are not just my ideas or opinions. They are part of established economic and monetary theories. For example, the Trifine dilemma, explained by Belgian-American economist Robert Trifine, states that a country whose currency is used globally as the dollar must export capital and maintain a large foreign deficit to meet global demand for dollars. However, in the long run, this generates internal imbalances, debt deficits, and political crises that obviously undermine the confidence in the currency itself. Precisely what is happening. Or consider the theory of fiscal dominance, which posits that when public debt is too high, the state loses control over monetary policy because the priority becomes financing the debt, not controlling inflation. In practice, the central bank will no longer be able to raise rates to curb inflation, because doing so would cause interest payments on the debt to explode. All of this leads to a diversification of foreign exchange reserves, with central banks starting to buy fewer dollars and more euros, gold, and other currencies. The percentage of global dollar reserves is already declining. Today, this share has fallen from 71% in 2000 to 58% in 2024, a signal not to be underestimated. Furthermore, it leads to a redenomination of commercial exchanges, with some countries like Russia, China, Brazil, and Saudi Arabia starting to negotiate in alternative currencies like the yuan, the ruble, or the euro. Increasingly, commercial contracts no longer use the dollar. For example, remember when China signed the agreement with Saudi Arabia to buy oil in yuan, the Chinese currency? This is a very strong signal. Oil has always been denominated in dollars, the so-called petrodollar. If this changes, the balance of the global monetary system shifts. The dollar's unique status allows the US to finance its debt more easily. However, this privilege isn't guaranteed. As the debt burden grows and the political will to address it falters, global confidence in the dollar can erode. We're already seeing subtle shifts. Central banks are diversifying their reserves, and some nations are exploring trade in alternative currencies. The percentage of global reserves held in dollars has already seen a noticeable decline. The Trifin dilemma and the theory of fiscal dominance offer frameworks for understanding this dynamic. The need for a reserve currency issuer to run deficits to supply global demand eventually undermines confidence in that currency. Similarly, when debt becomes too high, fiscal needs can dictate monetary policy, limiting the central bank's ability to control inflation. While the US remains a powerful and innovative economy, its ability to sustain this level of debt hinges on continued economic growth and, crucially, political stability and a commitment to fiscal responsibility. The challenges ahead are significant, and the path forward requires difficult choices. The world is watching closely, and the future of the dollar's reign depends on whether the United States can regain control of its financial destiny. What are your thoughts on this evolving global financial landscape? Share your opinions in the comments below. If you found this analysis insightful, please give this video a like and subscribe to Money Made Easy. For more in-depth discussions on the forces shaping our financial future, thank you for watching, and I'll see you in the next video.